A lot of this is more or less concepts, which is nice compared to like all the big math. I'll use the board. So, and internal controls, which internal controls more or less is just knowing we need to keep our assets safe, whichever which way. This includes protecting assets, ensuring reliability accounting records, making sure accountants can be trusted, promote efficiencies by reducing expenses and increasing profits, and encouraging employees to follow company policies. Obviously, we use a lot of words whenever we're doing internal controls because we have to deal with human error and also just human mind itself. Because some of these people that come into the job and don't really care. So you have to really calculate, okay, what's happening with my business? What am I to expect? And how can I try to get things running as best as we can? Because we got to protect our assets. We got to build our little fortress.
You want to be the team or you just want to get a paycheck?
Oh, yeah. And you know how a lot of people think nowadays. So that's why a lot of these internal controls, one of the big things to know is we can try our best, but nothing's ever set in stone. If you ever see a question that says, hey, can we fully control, what was it? Not fully control, making it reliable, but you can't like completely protect everything. If it says that it is, if there's any wording that suggests you completely get rid of every error, your internal controls are perfect and everything is absolutely stopped with a brick wall. We always know there's holes in brick walls. So that's something big within internal controls. So that's a biggest part from part one is just knowing internal controls, how they protect our assets, ensure reliable accounting records, promote efficiencies, encourage employees to follow company policies. It's also why we use like encourage, not make, because you can only really push people so far. The Sarbanes-Oxley Act, it's a law from 2002 that was used to require public companies to set internal controls. And the biggest thing you guys got to know is, hey, this was created due to Enron. And it requires public companies, and specifically public companies, not private, to have internal controls. Management must assess and report on the effectiveness of the company's internal controls. This is usually done through like internal audits. And external auditors must evaluate internal controls. Violators receive harsh punishments. And a little wordplay that helped me remember Sarbanes-Oxley Act is public companies have to wear socks.
That would find people that do LIFO and report FIFO, or got that transition, but the same thing.
Yeah.
Okay.
Well, not only that, but there's a lot of internal controls that a lot of companies have to get into. You guys won't have to know. You guys won't have to know like the specifics, but there's things like separation of duties. You have to make sure that you don't have the same person who's handling your cash reporting your cash, because that person can then adjust the records to pocket some cash in. And a lot of other internal controls, like making sure that whatever accounting system they're using is doing it correctly, that they're reporting the right tax correctly, not all that nitty gritty to make sure that the company can't hide anything, or that it's open for people and employees to take advantage of the system. Because, somebody, if they find an opportunity, they might try to take it. I've had a business where they left their checks completely open. Anyone could grab them. And so that's a terrible internal control, because if someone can just sneak a check in and they can't tell who it was, someone could commit fraud and might have already ran by the time they notice, kind of deal.
Right, or put it through cash, and Aunt Lisby or somebody whose picture shows up nowhere is the one who cashed it, and they got away with the money and they're still working for you.
Oh yeah. And it's just, that's why like Sarbanes-Oxley act is input and internal controls are so important in knowing those internal controls.
Right, but it stops at the point of being for public companies. So that more like that gives the stockholders more of an insider viewpoint that they're being covered.
Oh yeah.
Or if they had done it for a private and public company, it would just mean more money for the small businessman to have to spend on overhead.
Oh yeah. That's why a lot of private companies don't really have that, because it's both a good and a bad, because since it's not required for private companies that don't have great internal controls can get hurt by if they employ people, like especially if they have those kind of people, because they don't have someone to go through those internal controls. And a lot of private business owners haven't went through like all the research on internal controls, so they don't know how to properly set them up as well as they could when they're dealing with all these people, or even with record keeping. Like for small businesses, record keeping is really important, and having that kind of source trail, even if you don't technically get audited a lot of the times. And because you don't have that regular auditing thing that public companies have, there's chances that because of the because of a lacking source document trail, your clients could take advantage of you and all that fun stuff. Internal controls are very important. So kind of wrapping up on the limitations of internal controls, these limitations can occur by human error, fraud, or the cost benefit constraints, basically business decisions. Not everyone can get a fancy POS system that records cash consistently being going in and out of the business. So
she went over the part of control of cash, and 30 years I worked in my family's business, and I had $200,000 worth of equipment, $50,000 worth of inventory on stock, and an ex-employee breaks in, smashes a $250 picture window, and steals a $20 coffee caddy. You could have grabbed an amazing engraving machine and walked out with 50 grand. No, you had to leave your fingerprints and steal the coffee caddy. It's just the stupidity of thieves.
It's better they were stupid than they hurt you even more, though. That's hilarious.
Well, if it had been the $50,000 machine, it was insured. It would have paid for the $250 window and everything.
Fair enough. All right. So the fraud triangle. Did you go over the fraud triangle yet?
Yes, we'd just gotten into that. That it was opportunity, rationalization, and pressure.
Yes. So always know if the opportunity, basically, let's take that coffee caddy. They saw the opportunity to grab something.
Right.
They went for it. They broke the window, went through. There's our opportunity. Rationalization. They wanted coffee, I guess. Or something
or something instead of $50,000 sitting right there.
They really wanted coffee. That's our rationalization. We try to figure out what the rationalization is. Coffee.
And you're taking the risk on going to prison, which he did because he'd done it to several other places. Would you take the risk on $20 or 50 grand? Nobody said criminals were smart.
So yeah, no, honestly, taking that example, you could easily make that opportunity, the rationalization, pressure. That's just the three things to know.
But I'd have given him $20 not to break my $250 window.
True. No, it's I love people.
Yeah.
So she stopped at the control of cash, or did she go through the control of cash?
No, we really stopped at fraud.
Okay. Then do you want to get a heads up for the next one, and we'll just run through this?
Please. So number 2 controls cash, liquid assets, used readily to pay for liabilities.
Yep. So control of cash is really just knowing, okay, how liquid is cash? The cash itself, we can hand anyone cash. It's easy. We can it's right there. It's in our bank, like checking and savings. Those are cash assets. And really control of cash really is just knowing, okay, what's a cash asset? Cash assets, I believe, are anything that can be turned into cash under 30 days. She might have took it off of this notes, but I know it was on last year's notes. But it's readily convertible to known cash and close enough to their due dates, that their market value won't change, 30 days. So if I were to like throw some examples out, the cash in the cash register, cash in the safe, your banking account, your checking account, accounts receivable within like 30 days. So if you have like accounts receivable that you're gonna get next week, you just kind of assume it's cash, not on the books, but just when you're kind of balancing your balancing what you know is cash. But that's mostly just what you need to know for like cash and cash equivalents, especially for like that's the only questions that's going to be on Connect and the homework. I mean, the Connect homework and the exam is just knowing, okay, what is liquid? If I said equipment, is that readily liquid for cash?
No, but if you're the savvy bookkeeper and you just mark in Chase Limited and pay yourself every month, then you open up a Chase Limited account somewhere. Then if you're not the owner and you don't sit down and line item everything every week to make sure of that fraud, you may not ever notice it because the balance sheets would check.
Yep. We're going. Hello, we're going through chapter 6 right now. We're actually just running through and getting ahead.
Okay, that's good.
Do you have any questions for internal controls? What do you feel? How do you feel about them?
Like, what are they specifically? Like, I'm kind of like a little bit confused about it.
Yeah, so internal controls itself, think of them as kind of, it's the limitations that a business tries to implant to have a better way to protect their assets, in whatever which way. Encourage employees to maintain standards, ensure reliability, accounting records, ruin efficiency. Think of it as the laws of the business in a way. And the way, have you ever been into a job yet?
I'm about to get one.
You about to get your first job?
Yeah.
Okay, when are you getting that? Is that gonna be after the semester or during?
I don't know. I think it's after the
Okay.
semester.
So you're gonna realize something when you go into the workforce, that the job has standards and they have specific ways that they run things. This is within the machines they use and also with the attitudes attitudes and the methods they want you to use. For example, separation of duties. You don't want the same person who has your cash bringing it to the bank recording it, because they can easily pocket some cash and record something else. Other things that include are the point of sale system, like the cash register, where that will record every transaction that someone has. Whenever you see that receipt, it's put straight into the records of the business, so the cashier can't just doctor them. And things like cameras, it's basically, think of security measures within a business to make sure they don't lose their assets, that people can't commit fraud easily, and that they want to maintain standards so that they can protect their business model. Something very big and important to know too is that they're not perfect. You can never perfectly protect your business. There's human error. There is people that will collude and figure out ways to commit fraud if they group up together, even for example, a separation of duties, and just other little things that can happen. Does that help kind of?
Yeah. That's a little confused in the beginning. Like, that's good. That's good.
Yeah, no, when next time you're in like a grocery store, think of like, let's say HEB, when you're walking out and if you didn't pay for something, your cart stops and that the bells start ringing, alerting that you didn't pay, you walked out with something that you didn't pay for. Or if you go to a clothing shop, they'll have those little knob things on it that do the same. Those are both internal controls. Or if you notice that the cashiers aren't out there handling the merchandise at the same time. Everyone has their job. But we're now in controls of cash, which the biggest thing to know about that is just how liquid an asset is. So anything that can be turned to cash within 30 days is known as liquid cash. This is including like anything that's physically cash. If it's in the safe, that is considered cash. If it's in your bank accounts, is considered cash. And if it's an account receivable that you can get within a couple of days, that's considered cash. Now, if I said equipment, do you think that's liquid cash?
No.
Nope. Even if you think you could sell it within a week, that's not promising. Have you ever tried to sell it? Well, if you think about people trying to sell a car, sometimes they're trying to sell that car for 2 months, 2 to 3 months. Like, they're not going to get it fast. It's not insured. Inventory, on the other hand, that's also not promised either, because you never know. There's some things that sit in the shelf.
I would have thought that it would have been so like really specific since it's like a current asset. So it's like,
There's a difference between current asset and liquid cash,
oh,
or the liquidity of cash. Liquid assets can be turned in 30 days. Current assets can be turned in a year.
oh yeah.
That's the biggest difference. That's why I wanted to bring up inventory and why that one isn't specifically set. So next is the fun part about it. The big meat of this chapter is the bank reconciliation. And this is what people typically get confused on with chapter 6. And what the bank reconciliation is where you start to basically separate out and say, all right, here's my bank, here's my book. They won't match right off the bat. The biggest reason they don't match is because there's sometimes things that happen in the bank they don't tell us about, and things that happen in the book that don't tell the bank about right off the bat. So we'll say, for example, you might have $3,000 in your bank, but you might only have like $2,500 in your book. You have to figure out, okay, why are they different? Because the cash value, and this is all dealing with cash. The cash value of your bank and your book, you want them at the end of the day to be the same. And you might figure out, all right, the ending value is 3,500 for both. Because things happen. Now, what things can happen? We'll start talking about what happens with the bank first, because I find it, if you memorize what happens in the bank first, everything in the book comes a whole lot easier, because you just have to think, okay, does it deal with the bank? Nope. All right, let's move on to the book.
And there's a lot of things that you can do on your business controls to stop that. You're on there. We don't accept two-party out-of-state post-dated checks. It just makes a little sense that way, you know?
True.
There's stuff like some people don't accept Zelle, but do accept PayPal. You know, it's just, it's how you set it up that can make a difference.
Definitely. So the things with these usually happen, though, outside of like internal controls. So for example, the bank, outstanding checks. If there's a check that the bank hasn't recognized because it was paid for during non-bank hours, or like during the weekend when no one's at the bank to recognize it.
Night deposits, anything.
Yep. So deposits in transit, we'll put orange for the bank. Outstanding checks. And only three things that the bank does wrong. Deposits in transit, nightly deposits, where you don't get to see them until the next morning. Outstanding checks, when you can't control when the other person actually cashes the check.
Well, I had one customer who wrote all their checks out of a California account, and it's always a 10 to 12 day. Even though it's good, she had the account for 30 years, $200,000 in account for $13,000 balance. It still held those 10 to 12 days.
What do you mean by outstanding checks? Like checks that are like, that should have been like cashed out before?
So it's kind of like the same deal he's talking about, where like someone pays something and it takes days to actually like commit to the system. It's either by the bank standard, like checks that the bank that the other person uses, where it's not recognized for 12 days. So you have to just keep that into your mental mind when you're going through the bank. Or let's say if that person hasn't cashed it in yet, we're waiting for them to cash it. And we have to keep in mind, hey, they haven't cashed it yet. I once sent, an example I can give, I once sent a check to the IRS through mail instead of on their online system. So I wrote out the check, put it in an envelope, sent it out. It didn't get taken out of the bank account for 2 weeks.
I live in San Jacinto County. My county tax assessor only makes their bank deposits, even though it's across the street, every 10 days. So she can actually functionally make you late so you have to get the receipt from your deposit in hand because she might not deposit for 10 more days. Fortunately, this year I was a month early, but these things do happen.
Yep. So that's why they're part of the bank issue, because we can do everything we can, but we can't control what the bank is able to recognize. So you have to keep that in mind. And bank errors, banks can do errors. Banks can completely do errors. There's times where a bank will add or take out funds thinking that your business is someone else's business. So for one of the examples you guys have in your,
Is that bad?
it doesn't happen a lot, but it's something that happens. So in your guys's bank reconciliation example, let's see, not this one, where we're the Ginger's Floral Shop, and there was a check written by the gingerbread shop where the bank took out about $20 out of the account for the gingerbread's records, but we're Ginger's Floral Shop.
Oh.
The other thing is banks are federal, savings and loans are state. So you've got 2 different sets of rules to go by with that also.
Yep.
But my favorite one is when the bank adds a 0 and then reconciles it with itself and takes it back out before you've had a chance to make an adjustment.
So no, that's completely right. The fun thing about bank errors too, I don't know if you guys are going to be having to do journal entries. I know we had to cut it out last year for time, but just in case, so you guys know, you never have to do journal entries for bank errors. We just have to, in real world, we have to tell the bank, hey, something's wrong, not for deposits or outstanding checks, but for bank errors specifically, because we can't control their books.
And, when you go through business law, you'll find out that checks are only good from the date that it's written for 6 months.
Mhm.
So if you put a major check in to pay off something that you purchased and your customer is holding it until their next physical quarter to make the next physical quarter look good, then you send them a notice at the end of 6 months and said, this check is null and void because you held it for 6 months.
Yep.
Do they last that long, like checks?
Yeah.
Yeah. Oh, yeah. You can't. Yeah. You can only, like I said, if your weakest quarter is in December and you get a check in February for $150,000 and you save it and put it in December 1st to bring that quarter up, that check is null and void. They can't do anything with it. It's more than 6 months old.
Mhm.
Oh, I didn't know that.
Yeah.
I don't work with checks, so.
Yeah.
Like years.
Since you're in accounting, you're going to be taking business law, so you'll be able to learn that.
Okay.
And it comes with like a couple other things as well, like
Yeah.
stop checks and all that fun stuff. So the other thing about bank reconciliations is that these are rather going to be adding or subtracting into your balance. So deposit and transits, those are deposits that you put into the bank. So you're basically giving the bank money. So whenever we're reconciling, we have to know, all right, we're adding to the balance. Outstanding checks, we have to know, all right, that's money that's supposed to be taken out. So we'll subtract. Bank errors depends on if they're taking money or giving money. If they're giving money that shouldn't be there, you take it out. If they're taking out money that should have been there, you add it back in. So you basically just reverse. So bank errors and book errors, you'll see both of them. It's really depending on, okay, what's happening and why is it happening? I like to use T-charts all the time. So if you go through it normally, saying, all right, the bank took out $20, we know, all right, we have to fix that by adding 20. Reverse.
So what do you, like, that's for the bank errors, right?
Yes,
Okay,
you basically reverse what they did.
like, when they miscounted or like, when they
So-
took out?
So if they took out money, but it was an error, you have to, first, well, in the real world, let them know. But in homework practice, just know that you have to reverse it. You have to say, all right, they took $20 out. I need to add $20 in just so I can make it balance. Because we're not actually going through our bank records and forcing things to work. We're just trying to figure out, okay, why are we not balanced? Why is our book different than our bank?
So is it $20 coming out of our, like our account?
No. Well, yes, it's $20 coming out of our accounts, but because it's a bank error, we're adding it back in because it shouldn't have been taken out.
Yeah, but if they took it out, wouldn't it be their responsibility for that?
It is a responsibility, but when we're trying to make these balance, we have to add it back in. Because we're saying, all right, that was a bank error. So if the bank error didn't exist, how much would we
Oh,
have?
As an account, you're recording it, like, do you mean like that, like?
We're not recording it. We're just trying to make these balance. We're trying to figure out why they're not balancing. So we'll do an example after this. We'll take one of the examples she has in the book and work it through. But whenever we're dealing with this, when you see actual numbers to it, you'll know what I'm meaning. Because what we're trying to do is say, all right, why aren't they equal? Why is this 3,000? Why is that 2,500? So when we're going through each little bit that says, all right, they should have added these deposits in, we added in. This is a math formula, basically. We're not actually like telling them what to do. We're not making journal entries. We're just trying to make a balance. Does that make sense?
Yeah.
Okay, cool. But that's all the stuff for the bank. For the book, on the other hand, it has a couple more things. So we have our bank collections. So when the bank collects stuff without telling us, we have our electronic funds transfer where people take money out electronically. Let's say subscriptions. If you have a subscription and you're not keeping it in mind when you're writing on the book, you'll be able to figure out, oh, wait, this magazine I subscribed to took out $20 this month, and I forgot to add it back in. Because you don't have that physical record to basically be put on your desk saying, hey, here's your subscription. And you might just forget. We have interest revenue. When you have your savings account, or if you have your bank connected to whatever you're getting interest from, they'll collect that interest for you. And you just may not know. We have non-sufficient funds checks, or otherwise known as bounce checks.
Beats.
Yep. Basically, where, let's say if someone owes you money and they send you over a check, you put it in your bank saying wholeheartedly, I'm gonna see this $100. And then you don't figure out till you look at the bank reconciliation that it didn't go through. Basically, they didn't have money in their bank, so it bounced. And then book errors. You guys see why I started off with bank first? Banks have just little 3 things.
Oh, yeah.
Books have everything else. So again, with each one, you have different scenarios. For bank collections, think of it as the bank is collecting on your behalf. The bank basically was able to get whatever someone had to pay you. Like if someone owed you a note receivable, if someone owed you money and they gave it to your bank without telling you. That's a bank collection, where the bank collects on your behalf, but you just don't know it until you till you get that not bank reconciliation, the bank summary. Why am I forgetting the words for it? Bank statement, not bank summary. So think of bank collections as, okay, the bank collects. EFTs, electronic funds transfer, this is dependent on if you're losing money or gaining money. So if we know that we paid for a subscription, it's a minus. If we know that we are the subscription service that people are connected to, we add it back. It really just depends on where the funds are going and what the question is. Interest revenue, again, that's revenue, that's stuff coming to us. It's very similar to bank collections, just about bank collects money on our behalf. Non-sufficient funds checks, those are always going to be taken out, because what do you think happens when accounting gets a check? What do you think they're going to do into the books?
Debit it, credit it.
They're going to debit, when they receive the check, they're going to debit cash and credit account receivable. Book errors is the same as bank errors, where you have your accountant. And again, these are human errors. This is why internal controls aren't perfect, because people make mistakes. You might put, let's say, I paid a check for $100, but in the books I accidentally put 10 because I'm going too fast and I'm just rushing through it. So then when the bank and book don't match up, I'm able to figure out, oh, the $90 this is off because I didn't do what I'm supposed to. And again, you need to make these T-charts, because you can't just reverse for book errors. Book errors aren't as easy as bank errors, because bank errors, you just know, oh, the bank messed up, so I need to reverse it, or depending on things.
That's okay. I was confused a little bit at first, but now that you explained it.
This is all kind of starting to,
Yeah.
yeah, no problem. So like, for example, we'll take that example I said where, all right, I wrote down 10. You always write down what you have on the book first. You always write down what you have on the book first.
Like cash?
Yep.
Okay.
You just make a T-chart. Just always make a T-chart.
Where's
Hello, welcome
everybody
in.
go?
Where do you go?
No, where's everyone at?
Oh, we had one other person, but they just left. Right now, we're going ahead. We went through internal controls and we're just getting a head start on chapter 6.
Wait, did we just do chapter 6?
You did the internal control part of chapter 6, but you didn't do,
Yeah, the example.
yeah. So we're out on the bank reconciliation and I'll run through what it all is.
Okay. We'll send it into apps.
So for book errors, it's not like reverse, like for the bank errors.
Yeah, you just have to kind of figure out what's wrong. So for that same example I said, where, okay, this is the true value we need, that $100 that we put into the bank to pay what we took out of our bank because we paid for utilities or something, we wrote it as 10. We wrote it as 10, so you put 10 up here and you put 100 down here, and we know, all right, we need to fix it by 90.
Yeah, unbalanced, because we actually put 10.
So we know because it's on the right side of cash, we subtract it. Now, if I were to do another example where, let's say, I accidentally put $1,000 in the books, but we only paid this for 100. Well, we know we have to add back in 900 to make a balance. So you see where I'm going at this? Figure things out.
I'm gonna keep that.
So wait,
Yeah.
all those just what add and subtract from each?
Yes. So I just wanted to wrap this part up, and I'm gonna restart the whole explanation for this guy, so you know where we're at. Because I know, I believe she hasn't talked about the bank reconciliation yet, right? Or has she?
Not a lot. She mentioned the definition for sure, but like it wasn't a big web.
It's not special, so I get the whole restart.
Hey, no problem. Nah. So, well, bank reconciliation is the biggest thing to do is you're trying to balance out your book and your bank values. We're basically trying to make them equal out. Because up here, this is our starting values for an example. Obviously, it's not always going to be these numbers. But we'll say if we looked at our bank account, the cash for our bank account is 3,000, and the cash in our books is 2,500. So the whole point of bank reconciliation is to figure out why and make them equal out, because they have to equal out at the very end of it. So for example, I always like to start off with the bank. The bank in my head is easier because you only have 3 things to worry about: deposits and transits, outstanding checks, and bank errors. Deposits and transits are where you got paid money and you deposited in the middle of the night. So the bank doesn't recognize it till later. And there's sometimes that some checks take a while to process. So it's just those deposits that haven't fully passed through the bank. And we always add those into the bank balance because we know that the bank hasn't recognized them yet, but we add them in. Outstanding checks is kind of the same deal where you pay someone, you write someone a check, but it hasn't been cashed in yet, or the money just hasn't been taken out of the account for whatever reasons. Those outstanding checks are subtracted out due to the fact that, you know, we had to pay that money. So technically we don't have that money.
I'm sorry, you just restate outstanding checks again?
So let's say we wrote a check out to the utilities. We needed to pay our utilities, so we write them a check, hand it to the man and say, all right, goodbye. And it doesn't get taken out till a week later.
Okay, I get it. So essentially it's just the same thing as last one, but instead of us getting paid, it's us paying out.
Yep. Basically, it's reversed depending on if it's an outstanding check or a deposit in transit.
Okay, great.
And then bank errors is, let's say if the bank is not perfect. Internal controls are never perfect. So the best example I have is one of the ones that Miss Yeager has in her notes, where we're the ginger floral shop and the bank took out money for the gingerbread shop. Now we're not the gingerbread shop. I've never seen gingerbreads here in this floral shop in my life. So we understand, okay, the bank made an error. We call the bank up, and in our currently, when we're trying to figure out, okay, why is things wrong, we just reverse it. So let's say they took out $20. We know we have to add back $20. They haven't given us our money back yet, but they're going to, kind of deal.
Okay, so this is just like the plain lines, you just add it now.
Yep, add it now, because what we want to do at the end of this is make this balance this. And this would be $20 short, if not for the fact we recognized, all right, we had to add $20 in because the bank made an error.
Yeah.
Now, I don't know if you guys are going to have to do journal entries for these, but one thing for a fact is that your deposits in transit, not your deposits in transit, your bank, you're not going to be telling your banks how to do accounting. Any bank issue is going to be the bank's responsibility, and you will never have to make a journal entry for it.
That's nice.
I know, right? Now, for the book, this is why I like to start off with the bank. If you memorize the bank, you could typically figure out the book, because what's on the bank won't be on the book. So with the book, we deal with bank collections. We deal with electronic funds transfers. We deal with interest revenue. We deal with non-sufficient funds checks or bounce checks. And we deal with book errors. Bank collections and interest revenue, I kind of lump up together, because essentially the bank collected money for you. Whether the bank is collecting a note receivable or collecting from people that owe you without you recognizing it, or they're collecting interest revenue from savings account that you don't know. Either way, you're adding funds back into your account that you didn't realize were there. You're basically looking there and saying, oh, I got money. Huh.
We are a company, right?
We are the company. For the company. Electronic funds transfers is basically, think of your subscriptions.
Oh.
You know, you're not keeping track of them all the time sometimes. So sometimes they'll take $5 out each month, and you just didn't put it in the book. So you have to say, oh, right, I did not get the physical invoice for this, but it was taken out of my bank. So I have to write it down on my books. The same thing happens if, let's say, we're the subscription company, where people are paying us money for our subscriptions. Well, we're not continuously getting checks. It's connected straight to our bank account. So the bank's just pulling money for us. So we know for a fact it's adding. So electronic funds, you can't really say if they're subtracting or adding without kind of a background of why. Non-sufficient funds checks or bounce checks is when someone tries to pay you. So let's say an account receivable gives you a check and you get this $100 check and what do you think you're going to do as accountant? You're going to write in the books. Now, when it's finally processed through the bank, sometimes it may bounce because the person doesn't have money. And when the person doesn't have money, they can't take it out. So the bank basically says, sorry, we're not taking this, and sends it back. We have to then reverse and say, all right, yes.
So like, when it comes to like something like that, I was gonna say like, is that, like, since we already wrote it off, like, not, like, you know, like, we got cash, or we recorded it for cash and I put it to account receivable. Does that mean we have to reverse that?
Yep, you have to reverse it. That's the journal entry for it.
Oh,
Yeah. Now I'm gonna run through journal entries for all of these guys. So, but just know for a fact, yeah, no, that's perfectly right. Your intuition is completely correct on what you would do to remedy the situation. So with book errors, it's what we were doing examples here for. Where let's say we have a utility bill for $100, but I put in the books $10 because I was really tired. What you have to do then is put what you put in the book here, and you put what you have in the bank here, and just figure out, okay, do I have to fix it by taking more money out or adding more money back in? The same happens up here. We had to pay that utility bill for $100, but in the books I accidentally put 1,000. You know, I was really tired. So we have to add back into our book 900. That way we're able to make everything equal out, because at the end of this, our cash accounts should be 1 for 1. A great example for book errors I like to put down is when I lost 3 cents. Because I think I put a 6 instead of a 9 or something, or a 9 instead of a 6.
Oh, that'd be fun.
Oh yeah, I did a bank reconciliation at the end of the year. And
30 cents.
so I had to basically reconcile the bank for the first quarter, the second quarter, the third quarter, and the fourth quarter, figure out, all right, which quarter did I mess up? What quarter has my error? And I've been essentially found it at the end, and then had to make a journal entry to fix it. Now, I did not have to do this, by the way. I am just a perfectionist. 3 cents usually doesn't matter as much, but I had to figure out why.
For 3 pennies.
For 3 pennies. For 3 pennies. I've had more errors like that before when I'm doing bank reconciliation, which is why bank reconciliations are fantastic. Bank reconciliations are, when you're going into accounting businesses, bank reconciliations are great, because that way you're able to figure out what's happening. You really get to understand your cash accounts. Again, bank reconciliations are in internal control, because this is a way to say, all right, what's happening?
On the bright side, they'll find 3 cents.
Oh, thank you. But yeah, so that's just a funny example.
So I bought some, what's it called, Scantrons today.
Now, for all of these, you do have to make journal entries for. Now, I was saying earlier, I know last year journal entries got cut from Miss Yeager's class because of time. I don't know if they will this year, so I'm just going to run you guys through the journal entries anyway. One big tip I have to tell you guys is that every single one of these will deal with one account for for debit or a credit. Can you guys make a wild guess from what we've been talking about?
Well, I already answered one of them.
So, but what's the one account? What's the one important account?
Accounts receivable.
Nope,
Cash.
cash. Every single one of these will deal with cash.
Yeah, I think this whole chapter pretty much just cash.
Cash. Everything here is just cash. So I'm gonna leave this thing up here, and we're gonna do this one by one. So bank collections.
Wait, which one's that one?
Bank collections.
Is that book? Oh, yeah.
No, it's bank collection. Oh, yeah, it's book. Book is the one that you're gonna do journal entries
Oh,
for.
yeah, right.
Yeah.
Bank does its own thing.
Yeah, bank, we don't control bank. We don't wanna control bank. I don't wanna fight with a banker.
Yeah, I think they might. Could you beat a banker in a fight?
Well, considering, I like to think so. I can't promise anything, so let's set up a one-on-one match of a banker and we'll find out. So, with bank collections, do you think we're receiving cash or losing cash?
We're
Receiving?
collecting, so yes.
So you know for a fact, your cash is gonna be what's debited. And let's put X here. And this can be rather account receivable, or I think more specifically, it's always note receivable. I think it's always note receivable. Let me take a look. It could be accounts receivable at times, but I think more specifically with banks and with like bank collections, it's usually more note receivable. Because usually that's by like a very formal document. And usually those are taking more higher priority than accounts receivable, which is usually, you usually have to send out monthly statements for. Note payable is when you write on the fancy form and say, I owe you.
The bank.
To anyone, really.
Oh,
A
okay.
bank is one good example. Bank is one good example.
So is under note payable just more formal version of an account receivable?
No,
Sorry, not
no
account
receipt.
payable, sorry, yeah, that's
Oh,
what I
yeah,
meant,
note
that's what I
receivable.
meant, that's what I meant to say.
That's what I meant, like, what is a note receivable again?
Yeah, no, notes, whether they're payables or receivable, are just a very fancy form saying, I will pay you on this day. I will owe you interest as well. And not only that, but this interest will accumulate. So you have to remember that principal times maturity times interest. So with electronic funds transfers, it's always going to depend on what's happening. So
Wait, note receivables and credit?
yeah, no, note receivables of credit, because if you think they gave you the cash, the bank collected money for you. So that cash is yours. They don't owe you money anymore.
Oh, so essentially saying, oh, yeah, okay, so it's just saying, we're taking away their, well, the debt.
Yes, perfect.
So the bank step?
Yeah, the bank giving you money, kind of.
Yeah, the bank step.
Yeah, the bank step.
Okay.
The bank collection step. But yeah, I'm gonna skip over EFT real quick and we're gonna go to interest revenue as well, because it's gonna be essentially the same thing. And sometimes it's even attached. I'm gonna actually erase this,
What are you raising?
this line.
So it's kind of like making your own, yeah, just, okay,
Yeah.
so just like connect it pretty much.
Pretty connected, because sometimes you have to remember note receivables gather interest. So this is why I connect interest revenue and bank collections, because of the time. Sometimes they're both together. They're like hip to hip, and all you have to remember is that part of that is interest revenue.
Just add it.
Yeah, you just add it on top. So let's say if the note itself was $10,000 and the interest was 600, what do you think your cash is going to be?
For 10,000.
Yep.
I didn't want to do it.
On the bright side, it's baby math. Oh, by the way, after the shot, buy chocolate milk or milkshake.
Milkshake.
Good.
But that's why I like to put them together.
Monty, I knew you were an intellectual.
I try. So we're gonna skip over to non-sufficient funds checks as well, because you already said that before, where you have to reverse things by putting account receivable in cash.
Non-sufficient funds?
Non-sufficient funds, because the original entry was we took cash and we got rid of account receivable. But since the check bounced, we have to reinstate that. It's not true. They did not pay us.
Supposed to be accounts receivable. Because they owe us, they still owe us. And we don't have, and then we're and so we're not getting cash out of it, right? So that's why it's credit, yeah,
Yes.
okay.
So with EFTs, electronic fund transfers. It depends. If you know you're adding it back in, you're putting cash. If you know you're subtracting it out, you're crediting cash. And then you just have to fill in the blank of what's happening. So we'll take the example where we had to pay for a subscription. What do you think is going to happen if we paid for a subscription we didn't know about? What are we debiting? Because we're taking money out. You credit your cash.
So credit cash from this one.
Yes.
Okay, so crediting cash, we are getting with the accounts receivable.
Well,
No, we wouldn't. Yeah, do we owe them? Since we're paying, we owe something, right?
so we paid a subscription. We didn't know that we had a subscription that we forgot about to put in the books.
Wait, okay, so.
Hey, take a wild guess.
So if-
Expense? I don't know.
Yeah, expense.
Oh,
Okay,
wow.
We'll just say service expense.
That's a service expense?
Yeah.
Oh, okay, I know, I realize that's service expense, I was thinking of it, I don't know why. This was like. service.
Honestly, I'm proud of myself.
Nice.
It's service expense because it is technically a service. And
Yep.
it is an expenditure.
Yep. And if it was like the other way around, it'd just be like, let's say if we were the subscription-based service, it would just be like service revenue.
That makes sense.
And it always depends on, okay, what's being asked. Like, that's what, the biggest thing is like figuring out, okay, what is happening here? Last is book errors. And again, that's also something you have to figure out. It's something you have to figure out, okay, what account's being used and why is this not adding up? So we'll use the same examples over here where, all right, we said, for example, 1, in the book, we have $10, but in the bank, we paid our utility expense for 100. So what do you think we have to do to fix that? What journal entry?
Sorry, what?
So in the books, we put down that we paid our utilities for $10, but we technically paid it for 100.
So we're gonna.
Are we?
We have to show that so do we have to show that we actually just add 90?
Are we adding 90 cash or are we subtracting 90 cash?
Subtracting 90 since we're paying it out.
Yep. So we have our cash, it's credited for 90. See, this is why you want it reverse. For bank error, technically you would reverse it, but you wouldn't make a journal entry for it. That's why I don't put reverse for book errors, because technically those are just added in.
So we have a credit to cash or debit.
What would your debit be if you're paying utilities?
Utilities.
Yep.
I don't know why I was thinking account receivable / payable, one of those two, ones in my mind earlier.
Now, we're not going to be dealing with any account payables and stuff here, from my knowledge. I don't know why there's all those little swirls.
Yes.
And so let's take example 2 now.
Oh, fun.
Yep.
So there's another example?
Same example where we paid our utility expense and we gave the company $100, but in the books we put 1,000 because I was really tired that day.
So we're gonna have to add 900 to our.
Take out.
Now-
No, because we said, because on the book, okay, so we actually paid $100 for it, but in the books it says we paid 1,000. So we just have to give ourselves 900?
Yep, we have to give ourselves $900. This is why T-charts are great, because they'll show you which way you have to do it.
So we debited cash from 900, then. Okay.
So,
Expense.
yep,
Yep, okay, great.
because that's overstated, because you didn't technically pay $1,000 to your utilities. And as accounting majors, you guys would definitely need to know this for the future.
Okay, so.
So I want to run through one of the examples that Ms. Yeager has for y'all. Y'all can pick between example 1, 2, and 3. So have the Bearcat Inc., we have Ginger's Floral Shop, and then we have Cartwright Company. Ginger's Floral Shop then. So I'm gonna have you guys leave me in this first, or if you guys want, since it's only y'all both, you guys can work on the board and try to figure it out. I'm gonna set up the banking book part of it, at least.
Once you get done that, I'll write it up there.
So you put the starting totals of the bank and the book at the very top. And then you work down. And at the end of it, it should equal.
Blind stats.
There you go. That's it.
Oh, there's the Ginger.
Yeah. So I'll put the bank one first, just to show you what example. So number one, it says balance per bank statement at July 31st, 4,000. Yep. So that's what we're starting off with. Now, what's the book one?
3,900. Whoa.
You didn't mess up that bad. It's like you put this in.
So from there, do you guys want to have a stab at it, or do you guys want to keep just walking this one by one?
Well, my question is we're like, when it comes, like, we're going into it, like, deposits in transit, now recorded by bank, like, do I just put that into the bank, but adding it?
Yes,
That's it.
that's all you have to do. You just have to go over here and say, all right, how much was the deposits in transit?
Okay. I didn't know if I was supposed to, like,
When I'm talking about we don't record things for the bank, it's we don't record journal entries. We're not gonna show the bank this. We're not gonna take this piece of paper and say, hey, bank, what's up?
what did you do wrong?
This be our little personal guide. This, okay, what is our true cash balance at the end of the day? So deposit and transits, yeah, we add those back in. Yes,
How do we know that's the bank?
Okay.
deposit and transits are
I was
always
wondering what
bank.
it did was.
Well, like, is the bank giving us that information?
Yeah, your bank statement.
Okay.
So, well, the thing is, and funny enough, I'm doing my own right now. So I have an example. We're not gonna look into it. But when you have a bank, you get these things called bank statements. And what they typically do is they show you every charge. And so you're able to look through this, and I'm able to look and see, all right, this was deposited, what wasn't deposited, because I can tell you on my book what I deposited. I know for a fact, someone gave me a check for $1,000 that's not in that bank. So I need to put that in deposits in transit because that hasn't been recognized yet. You guys are gonna, like in the real world, that's how it works. You guys are actually told the information here one by one, but in the real world, what would happen was you take this bank statement, you take your book, and you just start looking through it and figuring out what's wrong. Why is my book bigger than my bank, or why is my bank bigger than my book?
Okay.
So in your book and bank, I'm just curious, do they just like have every single thing that happened like last period, during the period, whatever?
Yeah, everything that's been accounted for in the bank. So obviously, like I said, with deposits in transit, if tonight I put $100 into my bank, I wouldn't see that probably till tomorrow. So it's just not gonna appear there until tomorrow. That's a deposit in transit. And the same thing for an outstanding check. It's not gonna be recorded in here till it's recorded in here. So if I know for a fact I spent $100, my bank should be lowered. So in my little paper here, I just say for now, all right, $100 was it's outstanding check. Does that make sense?
Yes, so what happens I know when it comes to reversing, like, it's like bankers only.
No, that's why I say reverse, because it's dependent on what the bank does. If they deposited money that I shouldn't have, I need to reverse it out. I need to say, well, they put $20 in, I need to take $20 out, because I'm gonna tell them, hey, you guys took $20 away.
As in like credit to cash.
Yes, so you technically credit cash, but you wouldn't make that journal entry. We're just kind of, this is a math problem. Right over here, it's just a math problem. We're not gonna worry about the journal entries till we finish this math problem.
So wait, so are we saying like for the bank in the book difference?
Yeah, it's just,
Oh, you have to look at it.
yeah, you have to look at the page.
Oh, like that one with the $20, like, are you saying, cause like okay, it says right here, like the bread shop debited money and it was supposed to go to their account, but it ended up in our account. So that means we have to take $20 out.
So, here's the thing with banks that we didn't get the chance to get into. Whenever the bank does anything, their debits and credits are reversed.
Wow.
So when you see debited, technically they took money out.
Okay, so they're kind of like debiting to their stuff and your stuff.
I understand. That's why we're walking this one by one. And you guys are also ahead of the curve. So you're not getting the traditional Jaeger lecture here. You're getting the unorthodox Monty approach.
Okay, cool.
So I'm gonna try my best and we're gonna get through this.
So banks are reversed.
Banks are reversed.
So for example, if there was like for an accounts receivable, it has no balance of
Like a debit.
debit, and then like in a bank, it would be a credit.
Not exactly. The reason why is because the bank's looking at this as a company approach. When they debit into our account, they're taking it out because they're taking it back. They are
Debiting to their account.
debiting to their accounts,
Accounts.
the bank accounts, their accounts, like the bank's actual funds.
Oh, okay, that makes sense.
That's why it's like reverse, because they're doing it through their perspective. So that's their debits and credits. And the way that we have to look at their debits and credits is opposite.
They're taken from us.
So weird.
It is.
Don't like that.
Okay.
Like, I think she typically, I know last year we took it out as debited, but like, because it's very confusing, especially when you're like going through everything, you're like debits and credits.
Liars.
If you see the bank come at you, their debits are your credits.
So
You're gonna give us $20 back. From the rent,
No.
into the rent.
Yeah, we basically have to say we have to reverse their bank error, yes.
So as a bank, are we looking at we're the bank or?
No, we're looking at what the bank does to us.
With a book.
Well,
We're
that's not
both-
that.
We're both the book and bank. This is our bank account and this is our book.
Oh, yeah, right.
Yeah, that's why we're not looking at this as the bank. That's why we don't say $20 was added because we're not the bank.
So bank debited me, they took from us
Yep.
$20.
So how do we fix a bank error?
You
By
let them
adding,
figure
by
it out.
us adding $20 into our account.
Yes. And calling the bank and saying, hey, what up?
Yeah, what you do, bro?
What you doing, bro?
I know I didn't do that.
So again, too, I love T charts because you're able to say, all right, the bank took out $20, so we have to add 20 in. But again, we're not making journal entries for bank. The bank will fix it on their own and we'll be able to be happy because at the end of the day, things will hopefully add up. All right. So note collected by bank, $1,025.
That'd be under book, right?
That would be under book. Are we adding or subtracting?
Adding. Because they're collecting for us, right?
Yeah.
Service. Well, we just talked about service charges, didn't we?
We did.
And I have.
So is this a bank error or a book error?
This should be.
We're on 6 now.
Service charge. What was it?
Is this a bank error or book error first off?
Look. Me going back to the notes, thinking I'm smart.
What is the service?
Yeah, the service charge, if you go to the notes.
Isn't it that EFD one?
Yep. So how do we recognize that the bank took money out of our account?
Oh, do we have to do two,
No. I only showed you 2 entries
Minus?
because minus. I only showed you 2 entries because EFTs can be adding or subtracting. It just depends on the scenario. So for example, this one we're subtracting because the bank took money out.
Hey, this looks like your service charge.
Yep.
An NSF check returned by bank, $35. So does that mean it bounced?
Yep.
Okay, so that means we have to take out $35. Take out, right?
Yep.
What NSF stand for?
Non-sufficient funds.
Okay.
It bounced.
It bounced. Accountants credited cash account for 175 rather than the correct figure of $100 in recording check 55. Yep. So how do we do a book error?
Wait,
Make a T
plus
chart.
75. Wait,
Yeah, like, so like, debit 75.
You're right that it's debit, but I just want to show you guys the best way to handle this, especially the test.
okay.
I understand some people don't like T charts, but I'm a big fan, especially because you do this. We accountants credited cash account for 175. Instead, do the correct figure. The correct figure is always on the bottom. That's how you guys knew. You can do this in your head, but trust me, as someone who tries to do stuff in their head, it sometimes fails.
The
The golden method.
golden method, lay it out before your eyes.
Oh, yeah. All right, so we know.
Sorry.
Now, outstanding checks.
Outstanding's bad, I remember, because I thought outstanding's opposite. So it'd be bank, right?
Yep. It would be bank.
The only reason I remember outstanding being bad is because I remember when I was reading, yeah, that's bad. It's opposite, what do you think it is?
All right. Now, are we adding or subtracting?
Minus 1 point?
Minus 120. So what I want you both to do is add up both sides and tell me what the numbers are.
Okay,
And you have to remember, you have to add them and subtract them to the beginning balance.
oh, okay, gotcha. Just go into like 2 steps like that, does it balance for each one, another row that actually has it.
So I have to add them and subtract them, and then what, subtract it from the.
So we only add and subtract the purple with the purple, and we only add and subtract the yellow with the yellow. So for example, for the bank, I'll add the deposits and transits to the original balance. I'll add the bank error back in, and I'll subtract the outstanding checks in. And then from that, I get a total.
Lastly.
So essentially what we're doing, I'm gonna move this over here. We're gonna focus on the bank first, and we're gonna move it right here. We'll start off with the beginning balance. We will add back in.
Basis, minus.
I just put it all out there for those at home.
Yeah, sounds right.
Yeah, this seems like tough at first, but once you understand what's happening, it becomes very, very easy.
There we go. Okay, we ignore the sloppy handwriting and we pretend I did it right.
So what's the numbers, y'all?
What do you mean?
1,950.
And what about for the book?
The same thing.
Exactly. And that will always be the case.
Is that like the, how it's, what's it called? Kind of how the accounting equation is always supposed to balance out.
Yep. Your bank should always equal your book.
Is
And-
outstanding checks like always subtracting?
Yes.
Okay.
Outstanding is the opposite of what you think it is.
Yep.
Because if you think outstanding, it's supposed to be good, and that's why.
So this is a great rundown. And why I don't do bank reconciliation problems off the top of my head like I do other things is because working backwards to figure out things is tough.
And so deposits and transits
It's good.
are added.
Yep.
And the bank, okay, because it's so looking at her notes, like, you know, the notes that she gives us,
Yeah.
it's a, I can see why bakers aren't like, they could be adding and subtracting. Because you have most of them.
It's dependent on the situation. In this situation, we had to add it back in because they took stuff out. That's why I say for bank errors, we're reverse. We reverse what they've done. We reverse their error of the ways. For a book error, it always adds extra steps because you have to figure out where we went wrong. And that's whether we understated or overstated the amount. You know, like those accounting firms, sometimes people will make mistakes. They'll hear one thing and put in another.
So, like the EFT, the electronic funds transfer, adding, subtracting, why did we subtract that
Because it was a bank service charge. They took it out.
of our account?
Yes. So we didn't see, basically electronic funds transfers is stuff we haven't seen because we don't have that paper to say, hey, here's your invoice, ma'am. Or here's your check. Like, you don't have someone who actually hands things to you. Instead, we have to look at the bank to say, oh, all right, this happened. Okay.
So what would it look like if we look at EFT if we had to add it? Like what's an example of that?
Great example, it would be like if someone, have you ever went to like a farmer's market? Huh?
Oh, wait, maybe.
What about a fair?
Yeah.
Yes, wait, maybe.
It's
So do you think they're consistent, like whenever they have those little chip read things on their phone? Do you think they're able to keep track of all the sales with just by giving the chip? They'll have to look in their bank later. That's electronic funds transfer. You don't have the cash handed to you. You're not physically putting in a bank. It's just going over everything.
It's like-
Now,
It's like a card then.
yeah, a card. So or
a card or a card?
No, card, like a bank
Card.
card.
Oh.
Yeah. So paying with a card, and if the person isn't keeping track of it, they'll have to look at the bank. That, or think of it this way too, if we were the subscription service, if we were the bank and we're taking money out, it might just automatically do that. We might not be in charge of that. So it's just stuff that transfers electronically that we just don't keep track of. Think of it that way. Does that help out?
Yeah.
So how's everyone feeling on this?
Alive.
Alive?
Great.
Better than before?
Yeah.
Good to know that dits exist.
Yeah, dits do exist.
Lots of them for them.
Oh, it's gonna be fun to do, so it's not gonna be horrible.
Like bank collections are always adding, AFT
On the
could
bright
be
side,
adding, or subtracting, interest revenue is always adding, service charges are subtracting, and book errors could be adding.
So, do you guys want to run through the journal entries for this? And we'll go to another
Sure.
problem. All right. So, do we do anything for the bank?
no, they do their own thing.
Yep, they do their own thing. So we're just going
I
to
erased everything.
ignore them.
I just cleared everything out, so sad.
We're going to first work on, we'll put numbers by these.
Oh, wait.
2, well, that's awful because now it looks like it's typed. We'll change colors. We like a rainbow board here.
It just rained, so.
So we'll do number 1 first. Bank collections. What do you think the journal entry for that is?
Wait, we lost on the.
3, 4. Is it 4?
Yeah, it's 4.
I'm sorry, what are we doing again? I forgot.
So, bank collections.
Cash,
Cash indeed. Cash debit or credited?
no debited, and then no receivable,
Yep.
has to be, like, not no payable.
I'd have to do a book after that. You remember my stuff?
I'm glad. Spent a lot of time on those.
Thank you, Lonnie.
You're
I
welcome.
appreciate it.
No, I'm genuinely very happy that they're useful.
Wait, what's the bottom? Oh, okay.
Yep. Here, do you want me to
Thank you
make
for
these
agreeing.
bigger again?
Oh, no, that's the last thing we did.
All right, cool.
Jealous.
So,
I see two.
number 2, bank fee.
Expense,
Wait,
debited,
would
and
be service
then
expense?
credited. I just say expense.
Was it gonna be service expense or,
Typically, you want to put like bank expense or maintenance expense. Anything to just kind of indicate what it is, because if you just put expense, especially on the test, if you do have to do journal entries, if you just toss an expense in any company, you're gonna be asked, okay, what expense?
Yeah.
Okay.
specifically.
okay, so just.
So
for
I
our
just
doing
said
that,
it-
just make a bank
I
expense.
just said it because I wasn't sure if it was service expense or something else.
Oh, so, yeah, so it's service expense.
Service expense, or I'm gonna actually put bank expense.
Okay, so it's bank expense.
Yeah. Oh. Yeah.
Those-
Is it because like they took out of our account?
Yeah. And it's such a routine expense that happens that it just makes more sense to note it as a bank expense. That way, when we're looking back, we're able to say, oh yeah, that's when the bank took money out.
We lost a lot of money from that expense.
Oh yeah. So we'll go to the non-sufficient funds check.
Okay, so it's gonna be account receivable cash?
Yep.
I didn't remember that one.
That's the one I remember. We were running.
Hey, this is the one that usually tricks up people because they look at non-sufficient funds and they're like,
Because-
why?
Yeah, it's balanced. I forgot about that one.
It's a bouncer.
That's a bouncer.
I like things that is balanced.
Book error, so we got $75, so it's gonna be 10.
Yep.
And so, let me think, so we can't 75, like, credits.
So what was the error on?
I would have to go back and look.
Yep, that's what you have to do.
I'll go check
It
it out.
was on apps. What's it about now?
Cash account.
So it doesn't really specifically tell you.
Credit.
Check.
Would be, okay, so.
We'll just kind of say, it doesn't really tell you the specific one, but we'll just say, all right, it was a
No payable.
no payable.
I'm guessing, I'm just saying something here.
Now, more than likely, it's rather like a utility expense or something, like some kind of expense. That or it's like supplies or something, like you paid money for it. So we're just going to put an expense for now.
Alright, so it's done.
I don't like
Got it.
She'll usually put something more detailed. But just know, like, you really have to look and see, all right, what's the issues here? So how you guys feeling on this so far, now that we went through the journal entries too?
Okay, I definitely need more to remember what journal entries go where.
Well, at least you know one thing. What's the common constant with each journal entry?
Money.
Cash. And if you do this part right, you're able to do at least half of a journal entry correct. Because you know, wherever you're adding the money in, you're going to debit your cash. And whenever you subtract the money out, you're subtracting your cash.
Like.
Yeah. Let's see. Do you guys want to do another problem like this?
Sure. Real quick, so just erase what I have in this box.
Yes.
Let's do 3.
Let's do 3.
Are we doing the whole like thing that we did earlier? Or?
Yeah.
Or is it, okay.
Same thing. This bank reconciliations are genuinely just rinse and repeat.
That's nice.
Yeah.
Rinse and repeat thing.
There can,
Some people complain about doing the same thing over and over. I'm like, that's the nicest thing. It's so predictable.
yep, that's counting.
Which is one again? The Second National Bank, right?
It's, yeah, Bearcat Second National. Yeah, Bearcat Second National Bank.
Noted. Alright, let's see.
All right. You guys can work on it on your own first, and then we'll run through it.
The banks.
Or like the bank in the book.
Yes. So it's never going to be one or the other. I mean, it's never going to be both. It's never going to be both. It will always be one or the other. Another thing, actually, I just remembered something that can help sometimes if it's harder to remember. Okay, who is who? Ask yourself, who knows about this?
What do you mean?
So if we're gonna look back over at the bank error, or all the bank stuff. So we look over at the balance per bank
That's about the first one we did?
on on the initial like format.
Oh,
So if we look over and look at deposits and transits, who knows about it? The book or the bank? Who knows about it? The bank doesn't know about it. They don't know the deposits are in transit. We know we sent money to them.
oh, and they don't know.
They don't know yet. Same thing with outstanding checks. We know we spent money and we wrote out a check and gave it to someone. The bank doesn't know that we took money out to pay for something. Same with the bank error. The only thing with the bank error is that no one knows anything. So if we look back over in Ginger's Floral Shop, I'm gonna do this little practice with y'all. Kind of explain, to help explain. So deposit in transit, and even says not recorded by bank.
Which one is it?
Ginger's Floral Shop.
Is that 4?
Wait, no, that's, we're in number 3.
It's 3, okay.
Yeah. Deposit in transit not recorded by bank. We know the bank did not record it, so they don't know about it. If we look at bank error, check written by the gingerbread shop, neither the bank nor the book knows about it. But since both of us don't know, it's a bank error because the bank messed up. Note collected by bank, who knows about it?
The bank,
The bank, but we don't know about it till we look.
right? So is that, so that would be,
A book error.
okay.
Well, not book error, but it's a book correction. Bank service charge, who knows about it?
The bank.
The bank.
Okay, so whoever doesn't know has to put it on their stuff?
Yep.
Okay, got it.
Wait, doesn't make any sense.
So with like the bank service charge, the bank knows they took money out of our account, but we don't know till we look.
So people that don't know, I think that,
Is which side you put this on.
yeah, they put the error on their account?
Yes.
They
Well,
gotta-
it's not errors, it's like corrections. We're trying to fix things. So like I said, with the bank service charge, we have to account for that. Because the bank took money out of our account and we have to now put it on the books because we didn't know. Same thing with the non-sufficient fund check returned by bank. The bank knew they returned the money. We thought we put a check in until we found out. Does that make sense?
I'm gonna be honest, I forgot what some of these accounts are already.
Like, I'm already confused with the first one.
What part are we on?
Like a check written by Bearcat.
Wait, that's not.
Okay, so a check written by Bearcat for $311 was posted in the general ledger as $11. So what happened?
Okay, so Bearcat, which is what,
Which is us.
okay. Okay,
Make sense?
yeah, I thought it was the bank for a second, I don't know why.
That's all good.
Wait, what question?
You guys just got back from spring break. Everything's all fresh and squishy in there.
What's an outstanding check again? Is it just check that bounces?
Yes. Wait, no. Outstanding checks. Think about it.
I know it's bad.
Now, is it bank bad or book bad?
It's bank bad.
There you go.
Okay, so that's what I'm looking for.
So like, checks written by Bearcat, like by us, have not yet cleared the
know.
bank amounted to 1,618, like. Is that like,
Wait, was it, is it out? Wait, it's not out, wait, is it outstanding check? Cause it's gotta be a bank problem, cause the bank doesn't know about it.
yeah,
Yep.
I was right the first time.
I was about to put bank here. I don't understand that. Like, how does that an outstanding?
So the reason why it's outstanding check, it's a check we wrote and it's in transit. It's basically whether
It's opposite of DIT, it's the opposite of. DIT.
it's opposite of DIT. It's
Instead of listening DIT, we're receiving, in outstanding, we're giving.
What is big?
deposits in transit.
I was like, what the heck is that?
I like saying DIT, it's a lot funnier in my head.
Hey, if it sticks in your head, that's good. So With deposits in transit, it's where like the money's in suspension, both basically both of outstanding checks and deposits in transit. The money's in suspension because the bank hasn't recognized it.
I just gotta remember, bit and outstanding are just opposites of each other. Oh, do you also put the plus and minuses on those there?
Yes, it is very important to know what's being added and what's being subtracted.
For service charges, their own account?
Service, well, bank expense service charges are all their own kind of accounting.
By the way, do these have to be like in an order technically?
It's just, as long as at the end it balances, you're good.
Okay,
So if you're like skipping from like 1 to 5 or something,
cause I'd like to have my debit, deposits and transfer, like, pretty much, it's at the top of my bank stuff,
mhm,
so. Ooh, is an overdraft a what's it called? Maybe a bank expense? Was it-
yes. Now remember, when the bank credits to our account, is that adding or subtracting?
Adding.
Yep.
I'm sorry, what?
So
No, I
when,
didn't hear what you said.
when the bank credits something from our account, is that adding or subtracting?
Adding.
Yep.
Okay, so I have to, oof.
Okay, I messed up so bad, I don't know.
I'm gonna run through it real quick and I'm gonna get a number and I'll let you guys know what the number is. And we'll see if that helps. Otherwise, we're gonna walk through the step by step.
Mhm.
All right, just letting you guys know. I have 7,725 even.
I am,
I did not get that at all.
no, I got 7,819 and I got 8,325.
That was kind of like that, but I had 7,777.
So do you guys want to start walking through it? Or you guys want to
Give me like 2 more minutes, I
Okay.
kinda wanna solve this.
2 more minutes? Let's see if you solve it.
I forgot what he said, so I'm gonna figure this. So the bank issued it.
So the bank issued it,
So the bank knows.
it's like a debit memo, like what it is, like, is that, so the bank knows about it, we don't know about it.
So we have to fix it since we don't know about it.
Yeah. So a debit memo, remember with banks, debit doesn't mean debit. It means credit.
Plus 520 right here. That's a
So it means the bank is saying, hey, we need money from you. We did a service for you. We need money from you.
Yeah, it's taking out of our
Bank
account.
Yep.
Okay, so if the bank statement includes 98 overcharge the draft of $98, we have to fix that, right?
Yes,
okay,
we have to fix
so
that.
I was right there. I have no idea.
We can do the last practice problem if you guys want. Just see how you guys go. But let's walk through this first.
Wait, the problem we just did?
So-
Whoops.
You're good. You're good. You just have to vocally tell me what's happening because I just like to have this for record. So when people come back to it, they're able to just jump back over.
Yeah, it's not like I just erased everything on accident.
I'll learn to forgive you.
Yeah, that's a time.
So a check written by Bearcat for 311 was posted in the general ledger as 11.
Yep, so that's gonna be a bank error.
Is
Sorry,
that a
book error,
bank
book error.
error?
Book error of 300. Because, why would it? Because our book is just wrong, right?
Yep, our book is wrong. We say it had 11 when it should be 311.
Yes, I hate when I do the $sign, I can just press 3 right after,
Checks written by Bearcat that have not yet cleared the bank amounted to 1,618.
Okay, so that's gonna be, what's not did, it's the other one, outstanding, it's outstanding for 1618.
And that's a subtraction, correct?
Yep. Because we're writing a check, but the bank doesn't know we wrote a check out to pay something.
Exactly. A deposit of $52 made by Macaroni Company was credited to the bank account of Bearcat Inc.
Okay, that's gonna be a, what's that? that's bank error, because no one knows this is happening. And it's, since the bank's crediting it to us, so it's actually a deposit to our account, so it's gonna be a credit, so we're losing. 52.
Yep, because we want it out of there.
I don't know, I'm just like over like wording it, trying to get it across my head.
Hey, if it works, it works. Whatever mental process gets you to the end goal. The bank issued Bearcat a debit memo for bank service charges for the month totaling $35.
Okay, so that's just gonna be a service charge, so in the book of $35, which is subtracted.
Bearcat deposited a check into their bank account at 3:15 on October 31st, 2022, after the bank had already cut off activity to prepare the bank statement. Deposit totaling $520.
That's gonna be a dip in the bank for 520, and that is positive.
Perfect.
I like saying dip, it's so much funnier than saying deposit.
Hey, like I said, whatever gets it to the end goal. If dit's what you remember, dit's what you remember.
It's still funnier, I'm sorry.
The bank did.
Dip.
Bank statement included overdraft charges of 98.
Sorry, what?
The bank statement included overdraft charges of $98.
So that's gonna
Big
be
fees.
what she just
Or
said,
EFT.
EFT.
$98 in the book.
I think I might just do EFT. This is nice.
The thing with EFTs is, if I'm gonna put EFT on the thingy, I'm just gonna have to take the time to remember that, okay, these kind of things would fall under EFT, so
Are
I
we
can just
allowed
mark
to
that as
have
EFT.
multiple EFTs on there? Like,
They're both the same thing because the bank statement did overdraft charges and statement, and a bank fee as well. So both of them would be bank fees. They just took money out of the account.
See,
So-
I did that at first. I put bank fee and then another bank fee, but I didn't know there was a difference.
Not really. They're both bank fees. Either way, they're bank fees. The bank charges.
Okay.
And
Bank charge money.
during the month of October, Bearcat received interest on its checking account of $10.
That's gonna be interest and revenue, interest / revenue, $10 book, positive.
Yep. And at the end, everyone gets
That money.
$7,725.
It's not very bad. Now that I look at it in hindsight, it's not bad. It's just, I got my signs mixed up on two things.
It's learning organization. At least it's not chapter 7.
I forgot chapter
You
7.
think
I'm
it
gonna
was
be
a hard
honest.
one like that one?
I think, yeah, you're gonna get a bank reconciliation. You
What
will
the hell is
get,
that again?
I feel like we'll get
This
one
is-
of them.
Oh, what we just did.
yes, you're
Oh,
going
I
to
see.
get at least one bank reconciliation to work through.
Oh, the whole test is nothing but bank reconciliations.
How lovely would that be?
No,
All right,
one of those.
one and done.
You said the first page?
Not the
Yeah,
first page, it's page 3. It should be page 3. Yeah, Cartwright.
Wait, Cartwright. Oh, you have to go back again.
Yeah.
I didn't go back far enough.
Yeah. So what's the beginning bank balance?
10 for 10.
10, 4,
Oh,
10. What about the beginning book balance?
98.90.
9890.
Why do I say it the long way?
So let's start with the bank first. What do we see on the bank? Did.
What happened in 1865?
What happened in 1865? What?
What happened in 1865? That's 1865. What happened in 1865? Give me
I
something
was
that happened in
thinking
the
of
year
something like
1865.
you did not say it.
So
What
we're
happened in
at,
1865?
Don't worry about it.
Come on,
okay.
tell me.
Now, what are we, what number are we adding?
1865.
All right, so what else in the bank?
Outstanding. That is
LC.
negative 1252. What?
OC.
LC?
OC.
OC.
Yeah.
What's
And
OC?
all of that,
Outstanding checks.
Oh, okay.
11,023.
Yeah.
Now, let's go over to the bank, the book.
Yeah, what I did wrong with that one is I added my outstanding because I forgot to make that negative.
Remember
See,
the,
I I did that too, but I fixed it.
Yeah, and don't you love that everything has to equal, so you know where you have to.
Yeah, I
fix?
know, it makes it so much easier knowing that I'm the one that messed up, because it's such a quick way to tell if you messed up too.
I love them. All right, so what about our balance per book?
Bank collections,
Bank collections, add or subtract?
add
Add.
1260,
You're always adding those, just so you know, always adding that.
add those.
All right, what else?
NSF
NSF.
check, a minus.
Minus 100.
You're always.
Yeah, NSF is when it bounces.
Yeah,
What about the last one?
When,
EFT.
I have a book error, sorry.
EFT.
It is book error. It's because our company wrote a check. So it's not like electronic transferred fund. It's not something that just happens. It was due to someone having to be at the book and saying, whoops.
So-
Yeah,
Oh, I don't know why I put EFT then, because I know EFT is when it's like,
oh, bank overcharges,
yeah,
that kind of,
charges,
some like bank overcharges or bank fees.
Adding
That's
and
all, that's,
subtracting.
that is subtracting.
subtracting.
Yeah, because that's the only way I can remember if it's an EFT, if it's like something the bank would do electronically,
Yeah.
like that.
Um,
Welcome to the club, how do you feel?
And just for fun, let's do some journal entries. This is only,
Okay, so
Three.
let's put big X through bank right now.
So we have, first one, we have cash and no payable. I mean, receivable. Receivable.
Okay, by the way, why is it receivable again?
because we got money from someone who owed us.
Okay, yeah, okay, yeah, it's a formal way of saying, it's a formal account receivable, got it.
Yes,
Okay,
it's
so,
a very it's a formal account receivable where you make interest.
okay, got it, so the NSF's gonna be cash credit,
So you need a credit card.
and then it's gonna be, what am I debit be, is it
No.
gonna?
For note receivable is where it's like you don't have a credit card, you have this formal printed paper saying I gain interest on what you owe me. And you owe me it this day.
I'm thinking NSF, I have no idea,
Wait, don't say it.
let me think. NSF. Wait, NSF.
Account seal?
You got it?
Yeah, it makes sense, cause it's check that balance, yeah, I'm thinking check that balance.
I was thinking so hard, I was like, is it accounts receivable? No, it can't be accounts receivable. And I was thinking, what's NSF? What is NSF?
Bounce
It's,
check.
just a bounce check.
Oh, yeah, it's bound, oh, yeah.
Yeah, bounce, so we're adding their account receivable back on. Okay, so it's gonna be, again, cash credit for book error here, right?
Yep.
$27.
I keep putting book value.
Yeah, okay, so what would you debit here?
So
I'm
what
thinking
did,
an expense.
it is an expense. Now what kind of expense?
Utility expense.
Utility expense.
That's why I was thinking in my head, I was like, is it utility, but I don't know what the utility would be though. What about my utility be in this, like, in this situation, or is it just like in general?
It's just,
Yeah.
it literally says it in the entry.
Yeah, it just says utility bill.
Yeah.
Oh, it says utility bill in there? I wasn't
Yeah,
reading that- I
and
wasn't
the
reading like
original
that.
journal entry included a debit to utilities expense and a credit to cash.
Yep,
That's more-
and at least I can get 50% of the question right every time. I can
Yes.
get that much right.
Yes, that's why it's such a good chapter.
Yeah, because you're guaranteed at least a 50
Yeah.
if you know what you're
I
doing.
like
it's a little
coming
bit-
to these, it helps me a lot.